A stock doubles. You watch it. It doubles again. Now everyone is talking about it. Your group chat is euphoric. Your feed is full of victory screenshots. And the moment you finally buy, the market turns. That feeling is not random, and it is not just psychology. There is a hidden math to FOMO, a math of attention, entry timing, liquidity, and fragile payoff distributions. In this video, we are going to break down why late buyers so often buy the top, why fast-rising assets attract even more buyers, and how to tell when the chart has stopped being information and started becoming a trap. This is not a video about shaming people for being emotional. FOMO is normal. In fact, if you participate in markets long enough, you will feel it. What matters is understanding that FOMO is not only a feeling, it is a decision environment. A rising price attracts attention. Attention brings in buyers. More buyers can push the price higher. But as that loop intensifies, the remaining upside can shrink, the downside can widen, and the quality of execution can deteriorate. So the real question is not, am I emotional? The real question is, has the math of this trade become worse than the story feels? At the most basic level, buying the top is a problem of entry price. Suppose an asset has a bull case target of 150 and a downside level of 80. If you buy at 100, your upside is 50 and your downside is 20. If you buy at 140, your upside is only 10 and your downside is 60. Same asset, same story, same world, but a completely different payoff distribution. That is the first hidden math of FOMO. When your entry gets worse, your expected payoff changes even if the narrative does not. And if you want a simple framework, you can think of expected value like this. EV equals Q times upside minus 1 minus Q times downside. Where Q is the probability the bullish outcome happens, U is your remaining upside, and D is your downside. FOMO tends to hit when U is shrinking, D is expanding, and people are mentally overweighting Q. One of the most important insights in behavioral finance is this. People do not evaluate every opportunity equally. They first notice a small subset of what is visible to them. Barber and Odean studied this directly and found that individual investors are net buyers of attention-grabbing stocks. Stocks in the news, stocks with high abnormal volume, and stocks with extreme one-day returns. That sounds simple, but the implication is enormous. It means most people are not choosing from the entire market. They are choosing from a short list created by attention, and that is the first engine of FOMO. Because when a price move is extreme enough, it does not just change valuation. It changes visibility. The asset enters your mental shortlist. Then your emotions and your analysis start operating on a choice set that was already filtered by the chart. Attention is not just a story. It shows up in data. Da, Engelberg, and Gao used Google search volume as a direct measure of investor attention. Their result was striking. An increase in search volume predicted higher stock prices in the next 2 weeks, followed by an eventual price reversal within the year. That pattern is exactly what you would expect if attention creates temporary buying pressure. In plain English, more people search, more people notice, more people buy. Price moves up in the short run. But if that move is mostly attention-driven rather than justified by fundamentals, some of it can unwind later. That is a powerful framework for thinking about FOMO. Not every price spike is fundamental information. Some of it is demand arriving because people are staring at the same chart at the same time. And when you buy into that environment, you are not just buying an asset. You may also be buying the afterglow of collective attention. Now we can formalize the loop. Here is the simplified hidden math of FOMO. Let attention at time be AT. Let retail demand be DT. Let price change be RT. A simple educational model looks like this. Attention. Tomorrow depends on attention today, recent positive returns, and the strength of the narrative. Demand depends partly on attention, and price responds to demand. That creates a positive feedback loop. Price rises, attention rises, new buyers arrive, price rises again. This is where FOMO lives, and this is also why social learning can become dangerous. Research on information cascades shows that when people observe other people's actions, group behavior can converge in ways that are fragile and sometimes misinformed. So the chart is not just reflecting beliefs. The chart is helping create them. This is where we need an important distinction. Sometimes prices rise because the market has learned something real: better earnings, better margins, a policy shift, a lower discount rate, a genuine change in expected cash flows. That is information. But sometimes prices rise, and the dominant reason people are buying is not a model, not a valuation, and not a process. It is the fact that the asset is rising. That is FOMO. The cleanest way to say it is this: information changes your estimate of value. FOMO changes your tolerance for paying above it. And when those two get mixed together, people start treating a rising chart as proof that the upside is still large, even when the rising chart may be the very thing reducing that upside. If you want to see the anatomy of FOMO in the wild, GameStop in January 2021 is almost too perfect. According to the SEC staff report, price, trading interest, and social media interest all accelerated together. GameStop price began to surge in mid-January. By January 27th, it closed at $347.51, more than 1,600% above its January 11th closing level. The next day, it hit an intraday high of $483. Then it fell by more than 86% from that intraday high to the close at the end of the first week of February. Retail participation exploded too. The SEC reports that the number of unique accounts trading GME rose more than sixfold in one day on January 13th, from 9,220 to 60,515. And this was not happening in a vacuum. The SEC explicitly describes a mix of huge price moves, huge volume changes, large short interest, frequent Reddit mentions, and mainstream media coverage. That is the attention loop made visible. The narrative becomes contagious, the chart becomes the ad, and every new buyer becomes both a participant and a signal to the next buyer. This is the part many people miss. Buying the top is not only about valuation. It is also about market quality. Late in a frenzy, your execution environment can deteriorate. In GameStop, the SEC found that on January 28th, the daily average relative effective spread was 0.54%, about 3 times the 2020 average of 0.18%. And the median size at the best bid collapsed from 4,720 shares during the first 8 months of 2020 to just 19 shares on January 29th. That means the market was becoming harder to trade cleanly. The SEC also reports 40 limit-up, limit-down pauses in GME during January 2021, compared with only 1 in all of 2020. So the hidden tax of FOMO is not just that you may buy after a huge move. It is that you may buy when spreads are wider, liquidity is thinner, volatility is more violent, and the cost of being wrong is mechanically higher. That is not just bad luck. That is bad microstructure. The same pattern appears in crypto. Bitcoin's 2017 cycle is a classic narrative attention episode. CoinMarketCap historical summaries place Bitcoin near $20,000 in late December 2017 and around $3,429 by December 7, 2018. And research on social media and Bitcoin metrics found that Google search volumes and Reddit submissions for Bitcoin rose to a peak in November and December 2017, then dropped sharply afterward. Now, to be clear, this does not mean Bitcoin had no long-run future. It did. And that is exactly why FOMO is tricky. An asset can be important, a story can be partially true, and you can still enter at a terrible time. That is one of the hardest lessons in markets. Being right about the asset is not the same as being right about the timing. So why does FOMO feel so convincing? Because it compresses a complicated decision into a simple emotional equation. If everyone is making money, and I am not in, I am falling behind. And once that happens, the pain of not participating can start to feel stronger than the risk of losing money. That is why FOMO often peaks when the chart is already most extended. The rising price acts like social proof. The crowd becomes evidence, the narrative gets simplified, and the investor stops asking, "What future payoff am I buying?" Instead, the investor starts asking, "What if it keeps going without me?" The SEC Investor Education Guidance is blunt on this point. Buying because of trends, influencers, or fear of missing out is not a sound investing framework. And this is not some niche behavior. A CFA Institute and FINRA Foundation study found that 41% of Gen Z investors ages 18 to 25 in the US and Canada cited FOMO as a factor in their decision to start investing. Here is a simple Quantly-style diagnostic. This is an illustrative framework, not an academic formula. FOMO risk equals recent price spike times attention spike times urgency divided by research depth times risk plan. The point is not the exact equation. The point is what it captures. Your FOMO risk rises when the chart has gone vertical, attention is exploding, urgency is high, your actual research is shallow, and your risk plan is weak or non-existent. Here are 5 practical signs. 1. You only became interested after the move. 2. Your thesis begins with social proof. 3. Your upside is fuzzy, but your excitement is precise. 4. You do not know what would prove you wrong. 5. The emotional pain of standing aside feels bigger than the financial pain of being wrong. That last one may be the strongest signal of all. Because once not buying feels unbearable, you are no longer evaluating a trade. You are trying to escape regret. Now for the important nuance. Not every fast-rising asset is a bubble, and not every breakout is irrational. Momentum is a real phenomenon. Trend following is a real strategy. But momentum with rules is not the same thing as FOMO. A rules-based momentum trader has a defined entry condition, a defined exit condition, position sizing, and risk control. FOMO has none of that. FOMO is what happens when the chart becomes your thesis. So why do people always seem to buy the top? Because FOMO changes the math of the trade before it changes the emotion of the trader. It narrows your remaining upside. It often widens your downside. It can worsen your execution. And it makes crowded behavior feel like confirmation. The hidden math of FOMO is simple. When attention becomes the driver, price can rise because people are watching, and people watch because price is rising. That loop can be powerful, but it can also be fragile. So the next time an asset feels impossible to ignore, ask 3 questions. What upside is actually left? What downside am I accepting? And am I buying value or am I buying attention? This is Quantly, the math behind every market. If you want more finance explained with equations, mechanism, and real data, subscribe. And as always, this video is for education only, not financial advice.